Hey everyone, this is Corey with Sims Investment Management, and this is another monthly market update. And July 22 was a great month as we've seen the market recover from the S&P 500. We're up about 14% since the bottom that we saw in June. Not saying that we won't retest the bottoms or that the market couldn't pull back again. Again, we're not prognosticators, we're not making predictions, but for the time being, it's been a welcome bounce off of that June bottom. And a lot of that's been attributed to earnings season, like we talked about last month, kicked off. And earnings, although have come down a little bit for some areas of the economy, we're still seeing companies have really robust earnings. And the earnings growth has slowed from 2022 to 2021. But that's natural when you think about how much the economy or companies grew from 2021 versus 2020. I think what's really important, some of the conversations that we've had with clients recently, is we need to look at things through a practical lens. Okay, so when people are worried about a recession and what does that look like, well, jobs continue to be very, very strong and growing. Inflation is a problem, but from a recessionary standpoint, even if we do have a recession in the next anywhere from 3 to 24 months, from a practical standpoint, do we think that people are going to stop buying iPhones and groceries and toilet paper and the list goes on and on? And you can sit there and look at the S&P 500 and the 500 companies that make up the S&P 500, and most of you would probably know about 80% of those companies, if I had to guess, or have used those companies in your day-to-day life. And unless you think that it's going to completely stop and fall off a cliff, we will get through this next recession. We'll improve, we'll innovate, and we'll keep trending higher as we have for the past thousands of years. I want to shift gears a little bit and talk about inflation, and I'm going to include a really great article and some charts that talks about how dividends have been such a great inflation fighter. And for those of you that don't remember or know, dividends are part of the company profits that get paid out to you as a shareholder, as a company owner in the stock. So a couple stats. So since 1960, the S&P 500 on just the price alone is up 68 times since 1960. So $1 in 1960 is now worth $68, or $1,000 is now worth $68,000. S&P 500 dividends since then are up 30 times. Inflation's up 11 times since 1960. So dividends have been a great way as companies are able to increase their prices and what they charge their customers. They pass along some of those increased profits to you in the form of a dividend, which helps you offset the inflation that you're feeling at the gas station and in the grocery store. To put this in a very simple form, if you're super worried about what it's costing you to pump gas at the pump, then go buy BP or ExxonMobil, because you're getting some of that money returned to you in the form of dividends and price appreciation because of them making more money. And that's what we do, right? We buy big funds and companies that are essentially returning some of your money to yourself because you patronize and support some of these companies. If 1960 is too long of a time frame for you to reference or look at, since 1990, the S&P 500 is up 12 times, so the past 32 years or so. Dividends are up 5 times, inflation's only up 2 times over that time frame. So whether it's 30 years or 60 years, dividends have been a great way to keep up with inflation. I'm going to end with 2 other quick things. They kind of go hand in hand. We hear about people talk about risk and being scared all the time. And I think it's important, again, to remind folks that there's 9 different types of investment risk. Most people just think of volatility, but there's a lot of other risk, like horizon risk and reinvestment risk and inflation risk, like we're seeing today. And I'm going to include that list So you guys can look at those and maybe zoom out the lens a little bit to realize volatility should not be the only risk we should be concerned of. And last but not least, I'm going to include a really great article that talks about the US dollar and why it continues to be the world currency. Sometimes we get that question, oh, aren't we worried about all the debt or the dollar? And we're still the best house in a bad neighborhood, right? So if the US dollar did not end up being the world currency, ask yourself, what would it change to? It's not going to change to the yuan or to the euro or to the Canadian dollar or to the Mexican peso. So like, what would be the world currency if it wasn't the US dollar? Most of these other currencies, including cryptocurrency, don't have enough issued currency to be able to absorb the amount of world trade. That is why the US dollar is the world currency. It's why it probably will never change. Never say never, but it would take a lot of market shocks for that to change. So we're trying out a new format for the newsletter this month. Hopefully you guys like it. I know this was a lot of information packed in, but just a lot to touch on. If you think this would be helpful to someone, please forward it along. And we will see you next month. Have a great Labor Day weekend and rest of your summer. Thanks.